Hi, I'm Jeff Hirsch. I'm here live at the Money Show Orlando with Rick Rule. He's now president and CEO of Sprott Holdings. These guys just took you over, and now you've in charge over there. What's Sprott Holdings? You've been in the mining and precious metals and precious metals equities business for years. But what's Sprott do?
Sprott U.S. Holdings is the U.S. Operational subsidiary of Sprott Inc., which is a Canadian domiciled and listed company that manages, in Canadian dollar terms, almost $15 billion, largely in precious metals and natural resource-related investments. So we help investors around the world manage their natural resource and precious metals portfolio.
So you have some assets under management, and you also do some financing or some other things with the mining companies?
We also operate in the capital markets business, raising money for mining companies. We are, I believe, the largest lender in the non-investment grade natural resource-based businesses. So when somebody smaller than a Barrick wants to build a gold mine and they look for debt capital, we're the largest player in the world in that space, I believe.
A little diamond drilling funding and all that kind of stuff?
Not so much that. Not so much that. On the
later down the line.
On the debt side, we're interested in collateral. We're not interested in taking risk.
So what's your view on precious metals right now for people as an investment, and where you think it's situating cycle-wise?
I feel pretty confident with regards to precious metals. Precious metals historically have moved for lots of reasons, but the most important reason is that they trade inversely to trust. Trust in particular in the U.S. dollar and the U.S. 10-year Treasury.
Flight to safety type trade.
Correct. You know, if you say that gold trades inversely as an example to the U.S. 10-year Treasury, the U.S. 10-year Treasury has been in a 35-year-long bull market, and my suspicion is if that bull market isn't over, it's much closer to the end than to the beginning.
Arguably.
If the inverse of that trade is gold, then the gold bull market, up 18%, I guess, in the last year, is much closer to the beginning than to the end.
And that last time you saw a bottom like that was about summer of 99, right?
Well, yeah, the last serious bottom was the year 2000, summer of 99. Gold bottomed, I think, 262, went into a 10-year-long ramp that sort of peaked out at 1900. The interesting thing about gold is that gold bull markets are very dramatic. They're periodic, but they're very dramatic. And then, of course, gold equities, which tend to perform better on the upside and worse on the downside than gold itself.
It's the old spinning wheel version.
The message for your listeners is that in terms of trading gold, you're either a contrarian or you're going to be a victim. Now, what's interesting, if you look at the 40...
You can't be a contrarian the whole way, though.
Well, you have to be a contrarian. When gold becomes very popular, and gold stocks become very popular, you have to sell.
But if you're a contrarian the whole way up, you're going to get...
Well, a contrarian presupposes that when the trade is unpopular, you buy.
Correct.
And when it becomes popular, you sell.
So give us a couple of tidbits of where you're putting people's assets and your own in the precious metals market.
Well, certainly right now, we believe that people have to own physical precious metals if they believe in the thesis. Physical precious metals have functioned for 2,000 years as insurance. And when people feel extremely confident like they do now, insurance is cheap.
So coins in the safe deposit box or GLD, ETF?
How you do it is less important to me than you do it. If you feel comfortable in GLD, by all means do it. If you feel comfortable owning physical precious metals, own the physical precious metals. Just do it. Don't worry too much about how.
Okay.
Just do it. I also feel that gold equities are historically underpriced, relative at least to the last 40 years. And when you look at recoveries from oversold bottoms, in the last 40 years there have been 8 recoveries. The least of which, the most tepid of which, was a 180-point increase. The best of which was a 1,200% increase.
Which one was the least?
180%. From bottom to top.
And when was that? I'm just curious.
1986. Pardon me, 1988 to 1989. That was the most tepid.
And then the big one was the recent one?
The big one was 2000 to 2006, which was 1,200%. It was a spectacular move.
Forgive me, these history things are important to me.
I get it. The point is not so much, the point is, I guess, that recoveries are dramatic. And they take place over fairly short periods of time. Most investors make 2 mistakes. They don't participate in a recovery until it's popular, which is to say, until it's almost over.
Non-contrarian. Well, listen, we could go on forever, but let's wrap it up here. And I want to thank you, Rick, and I want to thank everybody for joining us.
Pleasure.
And I won't leave you hanging.
All right.
Thank you.
Thank you.